Welcome, everybody. Thank you for being with us today. We're delighted to have Shawn on Honest Capital, and you're all very lucky today because a friend of the Family Office Insights and the friend of Family Office community in general, longtime professional and a friend of mine, Wendy Kraft, who many of you know, will be co-hosting today. So you'll be the beneficiary of that. So thank you all for being here today. We're broadcasting live from outside of San Francisco, Park City, Utah, where I am, and Wendy's in Chappaqua. So just a little Zoom housekeeping. As you know, we can't hear or see you, but we most welcome and encourage questions. And please, as they come to mind, put them in and we'll get to them as soon as possible. We got a bunch of folks on today, so we'll get to as many as we can, but don't be bashful. Go ahead and put them in the chat box or the Q&A. And with that, I'm going to hand it to Wendy and welcome her as our host today. Thank you, Wendy.
Thank you, Arthur. Welcome, everybody. We have a very nice group today. I'd like to introduce everybody to Shawn Badinni of Honest Capital. And I've asked him to give you a little bit of his background before he starts talking about Honest Capital. And with that, I'm going to turn it over to you, Shawn.
Okay, thanks a lot, Wendy. Appreciate it and very happy to be here. So I have my slides up. I'll just start going through my slides, and my background is kind of like the third slide or something like that. So we'll get to it pretty soon. This is obviously a disclaimer. I'm happy to send these slides to anybody who wants them, so you can read this more carefully on your own. But just starting here, this is an executive summary. I won't spend too much time on this slide because we're going to go through all these points in more detail. But at a very high level, my strategy that I run is a very concentrated, very long-term approach to investing in North American small and mid-cap stocks. I do really deep fundamental research on each of the stocks that I buy, basically trying to take a private equity approach, private equity style diligence, anytime I'm making an investment. And I'm highly selective. I only own a few stocks at a time, and that's an interrelated point. Because I only own a few stocks, it allows me to do really deep research on each company that I buy. And I will talk about my background very soon, but I spent a lot of time at my prior firm doing shareholder activism, basically engaging with the companies that I invest in and helping those companies in some way increase or accelerate shareholder value creation. And one of the things about my strategy that hopefully is very relevant for everyone on today's call is that it is very tax efficient. By only owning a few companies, owning them for a long time, I'm really not trading that much. And so really trying to maximize after-tax returns. It's also very transparent, it's very liquid, and really the goal, the overall North Star, because I do have a lot of my own money in the fund too, basically my entire liquid net worth, I'm just trying to compound at a really high rate over a really long time frame. And again, that's tax efficient and hopefully resonates with a lot of people on this call. So I will now talk about my background. And this slide is in reverse chronological order, so I'll start at the bottom and go up. But in terms of my education, I went to Harvard undergrad. I also went to Harvard for Business School for my MBA. And my first job out of college was at Blackstone. I worked at Blackstone as an investment banking analyst. And one of the things that ended up kind of influencing my whole career happened to me when I was working at Blackstone, which was I got staffed on a project working with Bill Ackman at Pershing Square, who obviously is a bit of a character who I'm sure most people here have heard of. But I got to work with him when I was really young, 22 years old, and he really influenced a lot of my thinking. And I really learned from him about concentrating your portfolio in your absolute best investment ideas. And also really just thinking like a business owner when you buy a stock, really just having the mindset that you're buying this entire business. And ideally, if if you're buying a stock, you should be willing to own that business for a very long time, if not forever. And that was kind of the way he thought about things. And that really resonated with me. So after my time at Blackstone, I spent a few years at a hedge fund in LA called Canyon Capital. That is a pretty big hedge fund. It was $10 billion of assets under management at the time that I worked there. And working there, it was more of a credit focused fund. And even though I only focus on equities today, I'm really glad I got that background in credit investing, because in credit, you spend so much time thinking about downside protection, protecting capital, making sure you get your money back, first and foremost. And because I run such a concentrated portfolio today, that idea of downside protection is still really important to me. Every investment I make, I'm putting a lot of my capital and the fund's capital to work in each idea. And so minimizing mistakes, making sure we don't lose money is supremely important. I spent the bulk of my career from 2010 to 2019 at a firm in San Francisco called Marcado Capital Management. That was actually founded by one of the partners of Pershing Square, who left Pershing Square to start his own firm, Marcado. And so the approach was similar in a lot of ways. We took a really concentrated approach. We took a really long-term investment horizon. But the biggest difference between Pershing Square and Marcado was at Marcado, we focused on small and mid-cap stocks, just had a strong belief that that's really where the most inefficiencies are in the market, the most opportunities to find really compelling investments. And at Marcado, I had a great experience because I was the first employee hired by the founder when he launched the firm in 2010. So I actually got to help him build the rest of the team, build out the culture of the firm, build out the portfolio. We had a lot of success, really good early returns that allowed us to grow to 3 billion of assets at our peak. And by the time I left Marcado, we actually had two different funds. We had a mid-cap focused fund and a small cap focused fund. And for the last 4 years I was there, from 2015 to 2019, I was a portfolio manager on the small cap fund. So that really helped me hone my own style of investing, find what works for me. And that's what led me to want to launch my own fund in 2020, which I did. And this next slide just shows that the early returns have been really strong. I launched my fund, Honest Capital, May 1st of 2020. And between launching May 1st and the end of the year, I was up 88% net of fees. So far in 2021, year to date, I'm up an additional 17.6% net of fees. So the early performance has been really strong. Obviously, it's been a really strong market environment with the indices up a lot since I launched. But if you look at these numbers, I still dramatically outperformed the indices. And one of the things that it doesn't say on this slide, but is true, is that because I launched the fund May 1st of 2020, I didn't deploy all the capital right away. And so throughout a lot of 2020, I was still holding a lot of cash in the portfolio. And so the 88% return last year was achieved not only with no leverage, it was actually negative leverage because there was a decent cash drag in the portfolio, and was still able to put up those kind of returns. And hopefully it just shows that a very concentrated portfolio of under the radar, small and mid cap stocks can really drive differentiated outperformance over time. So this slide actually shows some of the actual stocks that I owned last year that contributed to the really strong performance. And at the end of the presentation, I have case studies on a couple of these, so we can come back to a couple of them and talk about them in more detail. But hopefully when you look at these names, one thing that jumps out is that, hopefully these are a bit differentiated from what you might see from other managers. Again, I keep talking about, I'm looking at small and mid-cap stocks that are hopefully under the radar of other people. And so hopefully can offer investors like the people on this call some differentiated exposure to what you might see from other funds. So this slide is probably where I will spend the most time, because I've really tried to encapsulate my entire investment philosophy here on this slide in these 5 points. And so maybe I'll just start at the bottom left and go around clockwise and just talk about kind of the key tenets of my strategy. So starting at the bottom left, North American small and mid cap. I've already kind of talked about this, but just feel like that's the richest opportunity set. There's less sell-side analysts covering those stocks. There's bigger funds can't really look at the smaller companies. And so I feel like there's less competition. And if you're really selective, doing really deep work and looking at a lot of companies, you can uncover some real hidden gems in that small and mid cap universe. The next point on concentration is really important to me. Again, I've already mentioned it a few times, but the fund is truly a best ideas fund. Only my absolute best ideas go into the fund. I'm willing to be patient, wait to find really compelling investments, and then once I find them, concentrate a lot of my capital in them. And that approach, again, allows me to do really deep private equity style diligence on each idea. And it increases transparency for fund investors because they can know at any given point in time, what are the stocks that I own. So people tend to really like that. The point in the middle of the page, on the top middle, on value orientation, I want to take a moment to talk about, because I do consider myself a value investor. I do really focus on downside protection. I really am price disciplined and like to wait for really compelling entry points when I buy a stock. But I want to make the distinction that just because I'm a value investor doesn't mean that I'll just buy any company if it's cheap. I really still want to buy high quality businesses, ideally growing businesses. You know, just because I'm a value investor doesn't mean that I won't buy a growing business. I actually want growing businesses. I just want to buy them at good prices. And it's easy to say and hard to do. Easy to say that you want to buy a good business at a good price, but it's hard to do. But the longer I've done this job, I think one of the beauties of this strategy is if you're only owning 10 stocks, you're trying to hold them for a few years each, it implies that you're only buying a few new stocks a year. And so if you're doing that, I do think you can make sure that each stock you buy does check every box. It is a high quality business, it is growing, and you can get it at a good price. Again, it's not easy, but I do think it can be done if you're only trying to do it a few times a year. The next point on shareholder activism, you know, my style of activism has evolved, I think, less what you would think about with Bill Ackman and kind of the headline grabbing Pershing Square activism. The more I've been around the small and mid cap universe over the past decade, and then especially over the past year running Honest Capital, I've taken a broader definition and would call this more shareholder engagement. I have found that with smaller companies, it's actually easy to get to know the management team and the board. Oftentimes they are flattered that anybody is calling them or kind of spending time on their company. And so I think there's a way to form good relationships with some of these portfolio companies that I invest in, and then help them with different aspects of their strategy and their business. But sometimes it's in investor communication. You know, a lot of the companies that I invest in, by definition, I feel like are underappreciated by Wall Street. And so by working with some of these companies and helping them think about how they should be describing their business, what they should be highlighting to the investment community, I found can actually be a really effective kind of lighter touch form of shareholder engagement. And so that's something I've had a lot of success with over time. The last point on the page, the long-term investment horizon, is super important to me. And I truly think this is actually one of the true advantages that I can have in the market is just duration. The longer I've been around the stock market, it's just become apparent to me that so many public market investors are focused on monthly vol, quarterly vol, Just because of the seats they sit in, they have to worry about those kinds of things. And so I want to be upfront with all my investors that I am trying to compound capital at a really high rate over a really long time frame, but I am not trying to run a low ball strategy. And I think if you have that mindset, it actually allows you to make a lot of really compelling investments. You know, some of the best investments of my career have been situations where a stock is left for dead because it has an uncertain outlook for the next 1 or 2 quarters. And so a lot of people can't touch it. But if you look at the situation and you have a 2 or 3 year view, you can get a lot of confidence that the investment is going to provide a really compelling IRR over the entirety of that time frame. You just don't know exactly when it's going to happen. And those are the things I love to take advantage of, just taking advantage of other market participants' short-termism, I think is just kind of a pattern I've had a lot of success with over time. And I do think it's really well suited for family offices. And also, I mentioned earlier, but very relevant for people on this call, the beauty of it also is that it's highly tax efficient. If you're taking that long-term view, you're not trading that much, you're not incurring a lot of capital gains every year, very tax efficient. And so I do think this strategy lines up well for family offices. So the next few slides just go into a little more detail on the same points that I just made. This slide just simply shows the number of small and mid-cap companies is a lot bigger than large cap companies. This slide shows 100 million to $5 billion market cap. There are 3.5 times as many of those companies as there are companies with a greater than $5 billion market cap. So just again makes the point that it's a really rich opportunity set where I'm hunting. And from a shareholder engagement or activist standpoint, you're just more likely to find situations in that universe where boards and management teams may not have been pitched the kinds of ideas I might bring to them, either from investment bankers or from sell-side analysts, because a lot of these companies don't have sell-side coverage. This slide talks about how I construct my portfolio. Again, I'm happy to send this to anyone who wants to read it in more detail, but the main takeaway is I try to own 10 stocks at a time. This slide says 7 to 10 long positions. Since I've been running Honest Capital in the past year plus, I've averaged about 10 stocks in the portfolio. I don't use any leverage, which is really important. And but I do run pretty close to fully invested, pretty close to 100% invested. Sometimes I'll have a bit of cash in the portfolio in steady state. If I've exited one position and I'm waiting to find the next great investment, I might have a bit of the portfolio in cash, but most of the time I'm pretty close to 100% invested across roughly 10 stocks.
Hey, Shawn.
Yes.
Would it be fair to say, and it probably is hard to predict, but as new investors come in, is the probability, well, there's probably a lot of analytics behind this, but are you likely to reallocate to the existing shares, or just sit in cash until you find the next thing? Or like if money was just flowing in, how do you think you'll handle that?
So I do reallocate to the existing portfolio. I've kind of thought about this a lot as the fund has already been growing each month over the past year. Basically, when I get inflows, I just kind of reallocate to the existing portfolio pro rata, because if you don't do that, actually, for the pre-existing investors, it's effectively as though you have sold down their portfolio by the amount of the new money, which is not, it doesn't really make sense. So I think about the whole portfolio as 100 percentage points. And then, you know, if it makes sense to sell a stock and hold cash, regardless, I'll do that. But if it's just because of inflows, then I just reallocate to the existing portfolio. So hopefully that makes sense.
Thank you.
Yeah. So this slide talks about investment selection. What do I look for? I talked about wanting to buy high quality companies at good prices and how it's not easy to do that. But so I tried to illustrate on this slide some of the patterns I've found over time that sometimes present the opportunity to buy a high quality company at a good price, because I do feel like there are patterns that kind of recur that create those opportunities. So on the left side of the page, I just talk about what does a high quality company look like to me. To me, it looks like a company with a strong competitive position, a high return on capital, and ideally a visible runway for growth. And so what are some of the ways you might get an opportunity to buy one of those kinds of companies at an attractive price? The top right box talks about business transitions. You could call these special situations or corporate events, but I'm talking about things like mergers, spin-offs, restructurings, a company going through some kind of change, whether it be a management change or a strategy change or a business model change. Again, these don't happen a lot, but when they happen, they might create some dislocation in the market, where there might be some forced selling, or the market may just not quickly appreciate what's going on. And so if you can do really deep work, but do it quickly, which I can, because I'm running a relatively small fund and pretty nimble and can work really fast. Sometimes you can jump on these types of opportunities before the broader market figures it out. The bottom right box is another category that I kind of describe as situations where GAAP accounting doesn't really tell the whole story of what's going on. So some of the parts situations where a company might have different business segments that might be a little complicated to analyze, and may not, the consolidated statements may not reflect the full picture if one business is growing fast, but another segment is declining, or one segment is capital intensive, another segment is capital light. Sometimes if other people are screening based on consolidated financial statements, they might miss the full picture of what's going on there. Similarly, I talk about hidden asset value plays, like companies that might have asset value that the market isn't giving credit for, like restaurant chains that own a lot of real estate is one example, or even casinos that own a lot of real estate, or companies that have a lot of capital tied up in working capital that they might be able to actually release over time. These kinds of things I feel like sometimes get missed by the market, and those can either be opportunities for shareholder activism, where you encourage a company to monetize the hidden assets, or they can just be not activist situations, just a situation where over the course of my investment horizon, 2, 3, 4 years, I think I like the business, and I think eventually the market is likely to figure out the value. So I just want to spend a minute on risk management, because again, I do run a concentrated portfolio. And so people ask, what do you do to manage risk? Well, one thing at the portfolio level, I don't use any leverage at all. I've mentioned that before, but it's impossible to overstate how important that is. Like if you're going to have a concentrated portfolio, there's going to be volatility, especially in times where the whole market goes through a drawdown. By not using leverage at the portfolio level, you can ride those periods of volatility out without ever having to crystallize your losses. So that is supremely important. But most of the risk management I do does happen at the investment level, just really careful underwriting of the stocks that I buy and the prices that I pay for those. I listed here some of the things I like to look for when I buy a stock: companies with low leverage, companies with stable, predictable free cash flow or hard asset value. And again, just being extremely sensitive around the entry price that I pay. And frankly, this causes me to miss a lot of opportunities. I cannot tell you how many times in my career I have done a lot of work on a stock, liked the industry, liked the business, but was just waiting, hoping the price would come down so I could buy it a little bit cheaper. And it just never happened, and the stock ran away from me. It happens to me all the time. And frankly, frankly, it doesn't bother me actually, because I find enough opportunities to make my strategy work. And that's okay with me because I have an absolute return orientation. I really want to minimize the situations where I ever lose money. And you know, that's what I tell people about risk management. So this slide just has the terms of the fund and my service providers. Again, happy to send this to anybody who wants it, but BTIG is my prime broker with Goldman Sachs as custodian. EisnerAmper is the auditor. The administrator is HC Global, and law firm is Schartz's Friese, which is a San Francisco-based law firm here. So I do have some investment examples I can walk through. Wendy, I don't know if there's any questions. Otherwise, I'm happy to just go through a few concrete examples of stocks that I've bought.
I have a few questions.
Okay. Okay.
So obviously family offices love what we call emerging managers, which is just a catch-all for anything that's below 500 million. And we like it instead of the big managers because we can get you on the phone.
Yeah.
And when you get a big manager, what happens is all the institutions come in and then we're the red-haired stepchild. Nobody wants to talk to us. And it's like, you're nobody. So how accessible are you to your investors?
Very accessible. I'm very happy to talk with anybody anytime. Certainly the stage I'm at now, you know, I don't have that many investors, you know, so very, very happy to talk to investors, and I enjoy doing it. You know, I learn a lot from talking to people. And again, that's one of the nice things about my strategy, just owning a few stocks, owning them for the long term. It actually does free up a lot of time for having those kinds of conversations. So I'm happy to do that.
Another thing I'd love to ask, as long as I'm not annoying you, and then we have a question from the audience, is you went over risk and how you alleviate risk, but do you have any internal mandates like X amount of portfolio will not exceed in blah, 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 anything like that?
That's a great question. I should have mentioned that, but yes, I do have position sizing limits. It's just something that I've found over time. If you're going to be concentrated, you have to, I love concentration. I talked a lot about why I think that is one of the ways to drive really strong performance and differentiated performance over time. But for me, 20% of the portfolio in one position is as big as I'm comfortable with. And that's still, by most people's standards, that's a huge position. So I feel like it still allows me to be really concentrated, but I've just found that once something gets bigger than that, it starts to become a distraction, both to LPs and to me. And so, you know, I think 20% is big enough to take advantage of my best ideas in a big way, and also allow everybody to sleep at night.
Fair enough. And we have a question from the audience, which is curious how you think about shorting individual names in current environment, or if you short ETFs and indices. Another
great question that I also failed to mention, but so I don't short very much at all. Right now, I have one short position in the portfolio, and I think it's just 1 or 2% of the portfolio. And so I'm trying to compound capital at a really high rate over a really long time frame. And I don't care that much about interim volatility. And so if you take that mindset, it really actually doesn't make sense to short. And so I barely ever do it. The only times I do it are situations where I just find something that I think is really compelling on an absolute basis that stock is going to go down. So it's not a hedge to my longs. It's not something I do to try to manage my net exposure. It's just, I've found that in the course of doing really deep diligence, which I do on companies and industries, from time to time, you just inevitably, you find something where it's a situation where a company, you get a lot of confidence that a company's stock is going to go down because it's just overvalued and the company is not well positioned, or it's temporarily over earning. And so I like the ability to put those in the portfolio, but as you can see, I have one short position. It's 1% of my portfolio. So it's not something I spend a lot of time on. And actually this whole year, all of this meme stuff, I feel like has totally vindicated my decision to generally avoid shorting. I mean, this is why I don't really short very much. And so, like I said, I'm willing to do it in super rare cases where I find something that I feel is super compelling, but I would never short a stock that has a high short interest or is a popular short. I mean, I've known that for a long time. I did not need 2021 to teach me that. And like I said, I feel like if anything, 2021 has kind of vindicated that view of mine.
Fair enough. We have another question, if you're willing. Do you include options as part of your investment strategy?
I don't. I have the ability to, but I haven't done it yet, and I don't really plan on doing it. To me, it's another form of leverage, and I talked about why I don't use leverage. And for me, you know, certainly there have been times when I've had a great long idea that I loved, and I thought about buying options on it just to kind of increase the payout. But I always just come back to the fact that, look, if I'm going to be really concentrated, I really shouldn't need any leverage to achieve the kinds of returns that I'm trying to achieve. And so I'm happy to just own the stocks and own a lot of them, but just kind of make my returns that way.
Do you have AUM target for the fund?
I think I could easily manage somewhere between 500 million and $1 billion. If you looked at the names in the presentation, even though I talk a lot about small and mid cap stocks, it's a good question because I do consciously avoid micro cap stocks. You know, I'm not buying anything that's a $50 million market cap because I do want to be able to manage $500 million without having to change anything I'm doing. So most of the stuff that I'm buying is somewhere between $1 billion and $3 billion market cap, call it. So still small enough to get a lot of the advantages that I talked about in the presentation, but big enough that if I was managing $500 million tomorrow, I really would not have to change the portfolio.
Our next question is, do you provide position level transparency for long positions and how frequently?
So I do write quarterly letters, and of the 10 stocks in my portfolio right now, I think, so I've done 4 quarterly letters so far because I launched the fund a little more than a year ago. And of the 10 stocks in my portfolio right now, I think I've written kind of a deep dive write up with my investment thesis in the quarterly letter, probably about 7 of the 10 stocks that I own right now. So all my investors know my thesis on 7 of the 10 stocks. And frankly, if you call me, I'll tell you the other 3. I don't really have a lot of sensitivity around that. And so again, that my existing investors, that is definitely one of the things that they like. And I'm also happy to send those letters that I've written to anybody on the call if they reach out to me, just so they can see the kinds of transparency that I do provide, and it will give them a lot of insight into my current portfolio today.
So back on options for just a minute, and I think you were pretty clear on why you don't do them, but the follow-up question to that is, you don't consider them as a way to do risk reduction?
Yeah, so sorry, that I realized after I answered the question that might have actually been what the question was, and I ignored that aspect of using options. I don't, and again, it goes back to, what am I trying to do? I am trying to compound at a really high rate over a really long time horizon. And so I've thought a lot about these kinds of kind of hedging strategies using options, and I get it. Look, I get that they can be used to reduce volatility, but that's not what I'm trying to do. You know, again, I want to maximize the after-tax amount of dollars, 10 years from now, 20 years from now. And I'm not trying to minimize the volatility in the interim. And so that's why I don't use leverage in the portfolio. And, that's just what I think.
Last question for now, and everybody out there, you're welcome to put in more questions. Shawn agreed ahead of time he would take all comers, but I noticed the minimum in is $1 million, but it said you can call. So I just
thanks for pointing that out. I've had plenty of people put in less than that, and I'm still at a stage where I'm okay with that.
Okay, if you want to go ahead through the investment examples, and I'll be happy to post more questions after that.
Sure. Yeah, so I talked a lot about the kinds of stocks I look for, but it's always helpful, I think, to just talk through concrete examples. So one of the stocks I had a lot of success with last year was a company called Chatham Lodging Trust. It is a lodging REIT. It's a very simple company. It owns 40 hotels across the country. But hopefully, very few people on this call have heard of this company. That would be my guess. And my guess would be very few other managers that you're invested with probably own this stock, or certainly didn't have as much of their portfolio in this stock as I did. I had 10% of my portfolio in this stock after I found it. And my thesis was, I started looking at the company. It certainly sold off in the coronavirus pandemic, right? Like, it's a hotel company. Obviously, when it became clear that people were not going to be traveling for a long time, the stock actually went from $20 a share down to $5 a share. But as I started looking at it, a few things jumped out at me. First, as I looked at its hotel portfolio, the 40 hotels that it owned were in really good locations. They were generally in downtown central business districts and in really good cities: Houston, San Diego, Silicon Valley. So really prime locations. They also focus on extended stay hotels or other limited service hotels. So Homewood Suites by Marriott, Residence Inn by Marriott, Hilton Garden Inn, Homewood Suites, these kinds of hotels. And the nice thing about extended stay hotels is they're actually very high margin, because you don't have to clean the rooms every night. You don't need that many employees per property. They're not a lot of amenities. And so they are really high margin in normal times. And in pandemic times, which we were in, they have really low fixed costs. And so as I looked at the company's balance sheet and liquidity, optically, it looked like the company had a decent amount of leverage. But when I looked into it, they had no near-term maturities. A lot of their debt, or almost all their debt, was non-recourse to the parent entity. It was on individual hotels, just individual mortgages on different hotels. And so I like the fact that the debt was not recourse to the parent entity. And again, by virtue of the types of hotels that they operated, they were not burning much cash, even in the worst part of the pandemic. Like last April, and the company had a decent amount of liquidity. They had a really big undrawn revolver. They had some cash on hand, and they just weren't burning that much cash, even when there was no demand. So last April, they came out and said, we have 41 months of liquidity in a pandemic level demand environment. And to me, that was an amazing fact, because I didn't know anything else about the virus that anybody else didn't know, but I had an overarching view that, look, 41 months is a long time for the virus to go away, for people to start traveling again. And when I looked at the valuation, the company had paid $1 billion of equity for all of the hotels that it had owned. It had acquired them in separate transactions over the years, but you could go through and see what did it pay when it acquired each of these hotels. And it added up to $1 billion. And the market cap of the stock when I was buying it was $250 million. So it was 1/4 of the price they had paid for the hotels. And my thesis was super simple. It was basically like, look, they have enough cash to get through 41 months. I'm pretty sure by then people will start traveling again, and the market will start thinking this is worth more than $250 million. It's probably worth a lot closer to the $1 billion that they paid for it. And so I talked a lot in the presentation about how I have a long-term time horizon. I try to take advantage of short-termism of others. And that's what I feel like I did here. I bought a bargain that other people just wouldn't touch at that time because there was uncertainty over the short-term outlook. And sure enough, stock, I bought it around $5 a share in July of last year. And by the end of the year, it had doubled. So, that was a good one. The next stock I'll talk about, I'm sure is a company that a lot of people have heard of. And probably you do have other managers in your portfolios that own this stock, I'm sure. The company is IAC. And what I'll say about the difference for me is IAC is a company that I had followed for years. And I had literally done work on this company for years and always admired the business, but was waiting for a really compelling entry point to see if that ever happened for me to buy the stock. And it happened last year around a spinoff. So I talked in the presentation about corporate events and special situations. And that basically is what allowed me to get comfortable buying IAC at the price I did. So for those who don't know, IAC, it's a conglomerate of internet businesses. It's controlled by Barry Diller. It's been public for 25 or 30 years, has an amazing track record of shareholder value creation over that time. But what was interesting for me, last year, IAC was a $25 billion enterprise value, and the company owned a stake in Match.com that was worth $20 billion. And so it was a situation where the market was not really paying attention to all of the assets that IAC owned besides its stake in Match.com. And that made sense. It didn't really, the other assets that IAC owned, while it still owned Match.com, didn't really matter. The only thing that mattered for the value of IAC was the value of Match.com. And so it kind of made sense that a lot of people hadn't really focused on those assets. But I had, because I, for years, thought that it would make sense for them to do a spinoff of Match.com. And last year they finally did it. And I had done a lot of work on the other assets besides Match.com that they owned. And the day that IAC did its spinoff of Match, I bought a stock in the RemainCo, the IAC RemainCo, with all their other assets. And it was an amazing sum of the parts situation where the market cap was about $9 billion, but they had $3 billion in cash on the balance sheet. And they also had $6 billion of stock in another public company called Angie's List. And so it was very obvious to me that it was undervalued on a sum of the parts basis. It actually didn't take a genius to see that. It was a $9 billion market cap. They had $3 billion of cash, $6 billion of stock in Angie's List. And then they had all these other assets that they owned, including Vimeo, Care.com. They had a publishing business called Dotdash. They have a car sharing business called Turo. And then in addition to that, they own a bunch of smaller assets. So it was just around the spinoff. I'm pretty sure there was dislocation because you had a $25 billion company spinning off a $20 billion asset. So there were likely some large cap investors who couldn't own the pro forma company. And Match.com was more of a growth stock. The pro forma IAC was more of a sum of the parts value play. And so it was pretty clear that there was some rotation that needed to take place. But the nice thing about having a small fund like I do is I was able to really quickly build a really meaningful position for my fund. And sure enough, the day the spinoff happened, I bought the stock around $103 a share. By the end of last year, it was up 82%. And one of the things that really catalyzed the appreciation was Vimeo. IAC, IAC owns Vimeo, which is a video editing software business. And its business really took off last year in the pandemic as people communicated more over video and enterprises communicated more over video. And it's actually truly amazing. In December of last year, IAC announced that it was going to spin off Vimeo. And actually, just a few weeks ago, in May of 2021, IAC completed the spinoff of Vimeo. And Vimeo today has a market cap of $7.5 billion. And this is amazing because, as I talked about, I bought IAC last year with a market cap of $9 billion and was very confident that I was getting Vimeo for free. And today, Vimeo trades on its own and is worth $7.5 billion. So really amazing sum of the parts situation that I was able to take advantage of. So I have one more example. Let me see how we're doing on time. Okay, I have one more example I can talk about. And this is a company called Cardlytics. And this is another situation where this is a business that I had done a lot of work on, and pre-pandemic really liked the business, thought it was an amazing company, but just wasn't that comfortable with the price. And then the pandemic presented me the opportunity to buy this amazing business at a really compelling price, because it did have a decent amount of hospitality exposure. Restaurants, hotels are some of its biggest customers. And so the stock sold off a lot in the pandemic, but it was a wonderful business, had plenty of liquidity, no debt. And so I was really happy to be able to buy it in the pandemic. But for people who don't know what the business is, it's a really cool business. It's a digital advertising platform. They run these cashback offers inside of banks' websites and mobile apps. And so they have partnered with all the biggest banks in the country: Bank of America, Wells Fargo, Chase, PNC, US Bank, like basically every bank in the country they have partnered with. And they run these cashback offers on the bank's websites or in the bank's mobile apps. And it's a very elegant business model because, if I open my Bank of America app and I see an offer from Starbucks or McDonald's and I activate it, it's really a win-win-win situation where I get 10% off my coffee at Starbucks. Starbucks gets an incremental sale, and Bank of America also wins because they also get a small revenue share from the deal. And I use my card at an additional time, and I spent more time on their app, which is all things that they care about. And so the banks win, Starbucks wins, I win, and it's really a cool business model. And what's amazing about it, it took Cardlytics basically a decade to build up this position. Banks are notoriously slow movers. They're very risk averse. And so Cardlytics has spent the last decade doing trials with banks, convincing the banks to let them run these offers. And now they're very entrenched because they're in all the bank websites. It took them forever to get there, and the banks just don't move fast. They're not going to rip out Cardlytics anytime soon. And so Cardlytics now basically has a monopoly in this industry where they have 160 million users seeing their ads, which is actually makes it the second largest digital advertising platform after Facebook, which is an amazing stat. And the other thing about it that's so great is they have the ability to use people's credit card data and debit card data to serve them very targeted ads and offers, which advertisers obviously love because they can use your actual purchase history to give you a very targeted ad. And Cardlytics now, through all their bank partners, has access to more than 50% of every credit card and debit card transaction in the country, which is a super powerful data set to be able to use. And so one thing that's really interesting about the company today, like I said, they spent the past decade just building this entrenched position, but they have not really yet turned to monetizing that position. And so now they have the position, they just need to go out and sell more ads, quite frankly. And the quick numbers today, they have 160 million users. They're monetizing at $1.50 per user. And the company has a roadmap to take that $1.50 per user up to $10 per user, and that's not a misprint. And that is really, if you look at precedents of other digital advertising companies, like Facebook obviously being the best, but even others like Pinterest, the $10 should be very achievable for them. And so obviously, if you can take your monetization from $1.50 per user to $10 a user, you're going to just absolutely multiply your revenue and earnings. And so that's why, like I said, I was ecstatic when the stock sold off in the pandemic, and I was able to buy it because I think the long term for this company is super exciting. And it was only a $1.2 billion market cap company when I bought it. So I do think it was under the radar of a lot of bigger investors. And I really think that this is still one of my biggest positions today. And I really think it can be a multi-bagger over the next few years. And, even last year, I bought it around $45 a share in May, and it had tripled by the end of the year. And it's pulled back a little bit so far this year, but I'm really still very excited about the long term for this company. So that's the end of my presentation. Wendy, I don't know if there's other questions or if we want to wrap up.
If anybody has a question, post it now, because I'm going to ask a question. I'll let Arthur ask his, but I'm going to ask you the question family offices always ask. How do I exit if I decide to exit?
Like redeem from the fund?
Yes.
Oh, yeah. It's quarterly redemptions, 60-day notice. But I do have a quarterly investor level gate. And so I have two different share classes, a more liquid share class and a less liquid share class. If you're concerned about liquidity, you can go in the more liquid share class. And that just takes 4 quarters to get your money out. So there's actually no lockup at all. You can ask for your money back anytime, and you would get 1 quarter of it each quarter for the subsequent 4 quarters.
Fantastic. Arthur?
Yeah, Shawn, real quick, in the context of your stellar returns in 2020, and it might be a complicated calculation, but you probably know, how much did you maintain that into the next year? In other words, you bought things well, and did they revert back to the mean, or did they go up? What happened with some of those, the big wins you had? Did they maintain, or how did that work?
Yeah, well, so if we go back to this slide that kind of shows the biggest contributors to my gross performance last year, Cardlytics I just talked about, I bought that well, but I still think that that's a multi-year, really exciting story. Same with IAC, I bought it and the stock has gone up a lot, but a lot of the appreciation that has happened so far was just due to that Vimeo spinoff that I talked about. And so I have not sold IAC either. I still think there's a multi-year upside there because they still own a lot of those other assets that I talked about, like Angie's List, Care.com, Turo, which is a car sharing business it's really exciting. So, a lot of these are still playing out. Green Thumb Industries, I did not talk about, but that is a cannabis company that I think is a super interesting, secular growth story for the next decade. And I'm really excited about. I'm happy to talk offline with anybody who wants to talk about that. But I think that company is positioned incredibly well in the cannabis industry, which is a really long-term secular growth story. So, a lot of my big positions, I think, still have a lot of upside, especially over a multi-year horizon. Some of the ones like Chatham Lodging Trust, that was obviously more of a coronavirus rebound play. Same with Caesar's Palace, which was another one I bought, and same with IMAX, which is another one I bought in the pandemic, just thinking, people were bound to go back to the movies once the pandemic ended. So, it was a mix. It was a mix to answer your question. Some of these were just kind of, playing the coronavirus rebound before anybody else was thinking about doing that. But some of these, and frankly, some of my biggest positions are things that I think still have multi-year, really exciting potential.
Super helpful. Cardlytics is trading at about 1.7, and it's led by a female CEO, which is in Atlanta. I just looked it up. I couldn't help but look it up.
Yeah.
This has been super helpful. Great job, Shawn. I'm going to let Wendy wrap it up, and then there's other questions, but we'll send them along to you and have put you in direct touch with the folks.
Great.
Thank you.
Shawn, thank you so much. Not just for taking all the questions, but going through it in detail. If anybody has follow-up questions, send them along. We'll get them answered for you. And thank you again for spending your time. It's a precious commodity. We appreciate it. Shawn, thank you so much.
Yeah, thank you. Appreciate it.